Hi everyone, I'm Matt Ford, CEO and co-founder of Sidekick, and today I've got with me Cyril, our Chief Investment Officer. We're going to be recording a number of these different videos over the next few months to really lift the lid on Sidekick and tell you more about both the team and the product and what we're building. The topic of today's discussion is active management, but before we get into that, we wanted to really talk through a little bit more about the purpose and the mission behind the business and why we started Sidekick in the first place. And that is the inequity of wealth creation. It used to be so much easier to build wealth. You could go to university for free. You could then go and get a job for life at a good employer. You could get a mortgage and a house and then retire with a final salary pension from your employer. But that linear trajectory has changed. The average university student now leaves university with £46,000 worth of debt. Over the next 2 years, about 60% of us will move jobs. The average house costs about 7 times earnings. And other than in the public sector, it's incredibly rare to find final salary pensions anywhere. So the path to wealth creation has definitely changed, and we're having to take a lot more accountability for our own wealth creation. And we're doing that in a number of different ways, whether that's freelancing, whether that's starting an enterprise like Sidekick, like Cyril and I have done, or whether that is getting more involved in investing directly in the financial markets like millions of people over the last few years have done. But the playing field isn't level. Despite us becoming more of a society of investors, how we invest creates enormous wealth disparity over the long run. If you're an ultra high net worth or a high net worth, the opportunities available to you are huge. You can access often private banking facilities. You have expert portfolio managers investing on your behalf. You can access alternative investments to diversify your investments. You can also lock away your investments for a long period of time and benefit from the illiquidity premium. And if you often need cash, you can just borrow against those assets. But most of us don't have those same opportunities. We're stuck between a rock and a hard place. We either have to settle for market returns by putting it in passive products, such as indices and ETFs, or we have to turn up to the stock market and try and pick effectively ourselves, which is incredibly hard because we have behavioral biases that prohibit us from doing that as effectively. And we also suffer from informational asymmetries, which means that we often don't have the same information or tools as a professional investor. So the playing field isn't level, but it's not because wealthy investors are smarter than we are. It's just that the game is set unfairly. And that's the mission behind Sidekick. We want to deliver equal opportunities to create wealth for all. And to do that, what we're doing is we're building a modern investment manager for the next generation of investors to navigate today's changing world. To do this, there are 4 pillars to our proposition. The first is active management, the topic of today's discussion. Led by Cyril, our in-house asset management team is creating return-seeking investment portfolios. The second is alternative investments. So beyond just purely stocks, we aim post-authorization from the FCA to be able to offer other asset classes like crypto and eventually even wider ones. The third part of the proposition is a much more open, transparent, engaging investment experience. We want you to learn as you go. We want to involve you in the process to show you the why behind the holdings so that you know and feel and understand the investments that you have. And the last piece is liquidity. So we really want to encourage long-term investing. But if you do have a cash flow requirement, similar to how a private bank might offer it, we aim to offer a portfolio line of credit so that customers can borrow against their assets rather than having to sell them at an inopportune time. So on to that first pillar, which is the topic of today's discussion, active management. So to kick off, Cyril, do you want to tell us a bit more about yourself?
Yes, Matt, thank you. So my name is Cyril, Chief Investment Officer at Sidekick. I've got more than 15 years experience working in the asset management industry. Most of my career has been spent working at large institutional asset managers. I've got broad experience managing both fundamental equity portfolios, but also a lot of focus on more systematic or quant portfolios. I'm very passionate about investing for the long term and also integrating technology into the investment process where it makes sense to do so.
So this line between passive and active, it's sometimes a bit blurry, and even the terms passive and active, they can be a bit confusing. So shall we start with some definitions?
So passive investing and active investing are 2 very different things. A passive investor believes that the market is very efficient and it doesn't matter how hard you try, you just can't beat the benchmark over the long term. So passive investors are very happy just to have exposure to the underlying benchmark at the lowest possible cost. But what this means in practice is that passive investors have small positions in hundreds or even thousands of different companies. Now, active investing is very different to that. Active investors are very focused. They believe that if you do all the hard work and you pay attention looking at all the individual investments, you can actually beat the benchmark over the long term. And we believe that's the key difference between active and passive investing.
So long-term investing is at the heart of what we're trying to do at Sidekick. What role does active management have to support long-term investing?
So we believe active management can really add value in a few different areas. The first of these, active management can really help you exploit market inefficiencies. Well, we believe the market to be very efficient most of the time. From time to time, emotions like fear and greed and informational failures can cause a big deviance between share prices and the fair values. Active management can help you exploit these situations. So secondly, we think active investment can really help you smartly allocate your capital. As a passive investor, you allocate most of your capital to the largest companies, and these are generally the companies that have done very well in the past. But just because they did very well in the past doesn't mean they're going to do very well in the future. So active management can help you allocate your capital towards those companies that you believe are going to do very well in the future. And last but not least, we believe active management can really help you align your portfolio towards your investor values and principles. As a passive investor, it's very difficult to exclude companies that you believe are unethical from your portfolio. But as an active investor, you can take a very focused approach. And if you believe a company or a sector is involved in controversial business practices, you can just exclude those companies from your portfolio.
Let's address the elephant in the room, though. There's plenty of data out there to suggest that active managers often underperform the market. If that was the case, why on earth are we building an active manager?
Yes, that's right. We like to say that we're evidence-based investors. Now, that means we have to go where the data takes us. And if you look carefully at the data over the last 20 to 30 years, it does indeed show that the average active manager underperforms his or her benchmark after fees. But the data doesn't show that all active managers underperform all the time. If you look carefully at the data, you'll see there's a subset of active managers that have managed to perform really, really well over the very long term.
Being an average portfolio manager isn't good enough, and you need to be a top quartile portfolio manager. Are there any characteristics of these top quartile portfolio managers that we should be looking out for?
Yes, we believe there's a few things that really set a top quartile portfolio manager apart. The first and probably the most important of these is that they tend to think very long term. Over short periods, like say 1 year, the share prices are driven by short-term earnings trends or sometimes fickle investor sentiment. We think these are things that are very, very difficult, if not impossible, to predict. But over the long term, like 10 years, it's the things that really matter that drive share prices. And these things include a company's underlying fundamentals, the quality of the management team, and also a company's competitive positioning in the industry. The second characteristic that we think is really important for a top quartile portfolio manager is that they take very high conviction views in their portfolios. In practice, a high conviction view in your individual investments means that you've got a concentrated portfolio of 20 to 30 stocks.
Why 20 to 30 and not, say, 70 to 80?
That's a good question. So when you construct a good portfolio, there's two things that we believe you need to pay attention to. The first of these is diversification. Diversification is really important. So as a minority investor, there's only so much you can know about the companies that you invest in. And diversification is a way that you can mitigate the risk of the things that you don't know. And secondly, we think that you need to have high conviction portfolios. We think 20 to 30 stocks strikes that right balance between having a diversified portfolio but still having really high conviction in your individual investment ideas.
So long-term fundamentals are clearly really important for driving long-term returns, but there's something else we should probably talk about, which is valuation.
We think there are two things that really drive long-term returns. The first is earnings growth, and the second is the price you have to pay for that growth. So if you overpay for growth, you're unlikely to make a very good return over the long term. But equally, if you just buy cheap companies that fail to compound shareholder value over the long term, you probably also won't make a good return. So good fund management and like choosing good ideas for the long term is really finding those companies that are both attractively priced and can compound shareholder value over the long term.
And are there any other characteristics we should be looking at for these top quartile portfolio managers?
One thing that we think is really important, top quartile portfolio managers integrate uncertainty into their portfolio construction. At the beginning of this decade, none of us would have guessed that within less than 3 years, we'd have runaway inflation, a global pandemic, and a war in Europe. So great portfolio managers recognize this uncertainty, and this means that they integrate risk management into every step of their investment process.
So to summarize some of the conversation that we've had today, clearly avoiding average is critical, and finding that top quartile portfolio manager is really key. And it seems that there's a number of characteristics that a top quartile portfolio manager actually has. So that is a focus on the long term, it's having a more concentrated investment portfolio, it's thinking about things like checking their ego. And all these types of characteristics are things that we'll obviously be building into our own investment team when we're authorized by the FCA to be able to do so. So really enjoyed the discussion today, and hopefully it's been helpful for everybody to understand and learn more about us and what we're building and how we're thinking about things. Sidekick is not yet regulated by the FCA, but we have applied for authorization to operate. Prior to us being regulated, none of the information we've discussed today should be considered an inducement or an invitation to apply for any product or service from Sidekick.